So here we are looking into different average revenue curves will give different profit outcomes. So as an example, we have taken 5 different average revenue curves mentioning D1 AR1, D2 AR2, D3 AR3 and D4 AR4, finally D5 AR5. As you can see, we have drawn three different curves, demand and AR curve, secondly the average total cost curve, and then the average variable cost curve. So in the first situation, the blue region, it indicates that the average revenue is higher than the total cost curve. So at this point, what happens is the firm tends to make a supernormal profit. Supernormal profit is when total revenue is greater than the total cost. Moving to the pink D2 or AR2 curve, this is the point where the AR curve is equal to average total cost, that is at point A. So in this case, the firm tends to make a normal profit. That means where your AR is equal to ATC, where your total revenue will be also equal to your total cost curve. So here the AR curve and the AC curve both are tangential. So this is the long run shutdown point, which is point A. So it's AR is below this. If AR is below this, it will not produce in the long run. Moving to the orange curve, which is D3 AR3, at this level, the average cost is greater than the average revenue. So at this point, the firm will eventually make a loss, and in the short run, it will therefore continue to produce, but at least it should make some contribution for paying its fixed cost. So definitely it's a loss-making point, but still it can manage to pay its fixed cost. Moving to the fourth blue line, light blue line, D4 AR4. Along AR4, there is just one point, which is B, where AR is equal or tangent to average variable cost. So this is where you intend to point that the short run shutdown point is mentioned. So if average revenue is any lower, the firm will not even cover its average variable cost, and therefore it will not produce any. Looking into the last gray line, D5 AR5, here even the average variable cost is not covered, where average revenue doesn't even cover the average variable cost, and therefore the firm will not produce if faced with average revenue, with this average revenue line. So overall, the conclusion, at the first point, the firm is making a supernormal profit, and the second pink, it's making a normal profit, and in the orange, it's making a loss. And in the light blue, again, it is the shutdown point in the short run, and the gray one, even the average revenue doesn't cover the average variable cost, and therefore it will not produce any over there.